Welcome back to the Deep Dive. Today, we are firmly planting our feet in the future, or I guess the present, since it is February 2026.
Right.
And we're looking at a company that has been rewriting the rules of how we pay for things. We're
Yeah.
talking about Affirm.
That's right. And if you're still thinking of Affirm as, just that button you click to buy a Peloton during the pandemic, you are officially behind the curve.
Way behind. I was looking through their Q2 2026 earnings report, and the scope here is just wild. We're talking about time shifting your rent. We're talking about AI agents doing your shopping for you. And we're talking about what the CEO, Max Levchin, calls his sticker empire.
It's a fascinating pivot. They're really trying to move from just being a lending app on a checkout page to becoming a pervasive payment network.
A whole network.
Yeah, Levchin actually alluded to wanting to be the American Express of the 21st century.
That is a big ambition.
Yeah.
So for our sources today, we have the official earnings transcript from February 5th. We're hearing from Max Levchin and his CFO, Rob O'Hare.
And we've got the market data to see how investors reacted.
So our mission today is to unpack this whole transition and figure out, are they actually pulling it off?
And it's a complicated picture because on paper, they absolutely crushed the numbers. But the market's reaction was a little more complicated.
Let's start exactly there. The headline numbers. I mean, I'm looking at this report, and it looks like a clean sweep.
It was. It really was. Let's just run through them. Earnings per share came in at $0.37, which beat the consensus of $0.28.
That's a big beat.
A very significant beat. Revenue hit $1.12 billion, which was over $65 million higher than expected. And maybe most importantly, their gross merchandise volume, or GMV.
The total value of stuff sold.
Exactly. That jumped 36%.
So they sold more stuff, they made more money, and they were more profitable than anyone thought. Revenue growth up nearly 30% year over year. You'd think Wall Street would be popping champagne corks.
You would think, but in extended trading right after the report, the stock actually dipped about 4%.
Okay, let's unpack that. Why the long face? Wall Street.
It really comes down to expectations and guidance. While the current quarter was great, the guidance for the next 2 quarters suggests a slight deceleration.
A deceleration?
Yeah, they're projecting GMV growth to slow to about 30% in Q3 and then 25% in Q4.
So slowing down from 36% to 25%. I mean, that's still growth, but I guess momentum is everything.
It is, and there's a specific reason for it. They're comping or comparing against a period last year where they had this massive transition with a large retail partner.
So the comparison just gets tougher.
Exactly. But there's another layer here, and it's all about credit quality.
Right. I saw a quote from Max Levchin about this. He said their net charge-off lines, so the loans that go bad, are, quote, one on top of the other.
Which is a very specific way of saying we are incredibly consistent. They are keeping a very, very tight leash on who they lend to.
Okay.
They aren't chasing growth by lending to people who can't pay them back.
Yeah.
And in this economic environment, that discipline is crucial. But it also means you naturally cap your own growth ceiling a bit just to stay safe.
So it's the responsible choice, even if it's not the flashy choice for the stock chart.
Precisely. The consumer is healthy. They're willing to repay. But Affirm just isn't opening the floodgates to pump the numbers.
Okay, so that's the macro picture. But the thing that really jumped out at me in this report was the Affirm card. Because for a long time, I just thought of this as kind of a novelty.
Right, a plastic card for an app.
Yeah. But the numbers here are exploding.
It is definitely not a novelty anymore. It is becoming material to the business. GMV on the card was up nearly 160% year over year.
160%?
Yep. And active cardholders are up 121%.
That's serious growth. But how are people using it? Is it just for the big stuff?
Well, that's the interesting shift. Levchin talked about this group of users who have been, as he put it, purple-pilled.
Purple-pilled. I love that. So I assume that means they're all in on the Affirm ecosystem.
Totally. The logo is purple, so they've taken the purple pill. These are power users treating the card as top of wallet for everything. But then you have this other massive group just using it for considered purchases.
Okay.
And what's fascinating is that the definition of a considered purchase is drifting down.
Right.
People are using it for things as low as $50.
So it's not just for the $2,000 couch anymore. It's for the $50 grocery run or a new pair of sneakers.
Right. And they ran this promotional event they called The Big Nothing.
The Big Nothing. Sounds like an episode of Seinfeld.
It does, doesn't it? It was a huge 0% APR event. And it drove massive conversion, obviously. But the most critical insight they got wasn't about the sales spike.
Oh?
It was about user behavior. There's this myth in the industry that if you give a customer a 0%, free money, essentially,
Right, you spoil them.
they will recoil in horror if you ever try to charge them interest later.
Yeah.
They get used to the free lunch.
Makes sense.
But Affirm found the opposite. Consumers who start with a 0% loan are actually quite happy to cross-pollinate into interest-bearing loans later on.
So the 0% offer is the gateway drug.
It's a customer acquisition tool, effectively. It builds trust. Levchin made a really strong point that when a firm says 0%, they mean 0%.
No deferred interest?
None of that. No, if you're 1 day late, we charge you 30% backdated. It's clean. And that, he argues, builds a moat.
Speaking of building moats, let's talk about this sticker empire. This part made me laugh.
Yeah.
Max Levchin, CEO of a multi-billion-dollar company, joking about his fledgling sticker empire. What is he talking about?
He's talking about the other category in their revenue breakdown. Usually in these reports, other is the boring stuff you ignore. Here, it's growing at triple-digit rates.
And it's what, like 15% of their volume now?
About that, yeah. It's the long tail, it's the small businesses, the mom-and-pop shops, boutique online stores.
Places selling stickers.
Literally, places selling stickers and novelty items, niche goods. Levchin's point is that small merchants are realizing they are at a massive disadvantage if they don't offer buy now, pay later.
It's become table stakes.
Yeah.
If you're selling vintage stickers online and you don't have an Affirm button, you're losing sales to the person who does.
You are. And this diversification is so key because it protects them from being too reliant on 1 or 2 giant retailers. But it's not just small stickers. It's also international expansion.
Right, they're making moves in the UK.
Big moves. They announced a deal with VMO2, which is a huge device seller there. They're scaling with Shopify in the UK. They even launched a beta with Wayfair. The goal is pretty clear.
They want to be everywhere.
Everywhere Visa's accepted.
Okay, so we've got the stickers, we've got the UK, but now I want to get to the sci-fi part, the technology. Because they're not just sitting back, they're rolling out something called Boost AI.
This is a really, really smart pivot in their business model. Traditionally, a merchant pays a firm a fee to process a transaction. It's a cost of acceptance. Boost AI changes that conversation entirely. It changes it to marketing investment.
How does that work?
So imagine you're a merchant. You give a firm a budget, say $100,000. You tell them, I want to move more product. A firm's AI then runs automated A/B testing on their users to figure out exactly who needs to see a 0% offer to convert.
And who would have bought it anyway?
Exactly. It's clever. So instead of just giving 0% financing to everyone, which costs the merchant money, the AI just snipes the people who are on the fence and nudges them over.
It's surgical.
Precisely. It maximizes the merchant's sales per dollar spent. It turns a finance charge into an ad budget.
And then there's this concept of agentic commerce. This sounds like the next level. We're talking about AI agents shopping for us.
This is where Levchin gets really visionary. The idea is that in the near future, you might not go to a website to buy your coffee filters or even your TV. You'll just tell your AI bot, get me the best deal on a 65-inch TV.
And the bot just goes out and hunts.
The bot hunts. And here is Affirm's whole thesis. A bot doesn't care about a cool TV commercial.
It doesn't care about a celebrity endorsement.
No, a bot cares about math.
And mathematically, 0% interest and no late fees is the best deal.
Bingo. If an AI analyzes payment options, it will objectively determine that a firm's terms, no hidden fees, clear schedule, maybe 0% APR, are mathematically superior to a high-interest credit card with confusing terms.
So they want to be the default payment button inside that AI interface.
That's the bet. As shopping becomes more automated, the no gotchas model wins simply because the computer can't be tricked by marketing fluff.
That's wild.
Yeah, and Levchin had a great line about this. He said, we love channel conflict. He wants a firm to be everywhere, in Apple Pay, in the chatbot, on the physical card. He doesn't care which door you walk through as long as you use Affirm.
We love channel conflict. That is some serious confidence. Okay, let's move from the futuristic bots to the very real, gritty economy of today. They announced some partnerships that seem to be targeting the service economy.
Yes. Intuit and QuickBooks.
This feels massive.
It is. Think about the service economy plumbers, auto mechanics, HVAC repair. This is a huge chunk of GDP that buy now, pay later has barely touched.
Because usually, if my car breaks down and it's $2,000, I either pay it now or I put it on a credit card.
Exactly. And that is a painful moment. The Intuit deal is what they call B2B2C.
Business to consumer.
So when a plumber invoices you via QuickBooks, instead of seeing pay $5,000 due now, you might see an option.
Pay over 6 months with Affirm.
Exactly. That solves a huge cash flow problem for regular people.
And for the small business, too. The plumber gets paid immediately by Affirm, and the customer gets breathing room.
It unlocks a part of the economy that isn't just about buying stuff. And they're doing something similar with Fiserv, helping banks.
Right.
Most regional banks don't have the tech teams to build a BNPL system. So Affirm is partnering with Fiserv to basically let banks use Affirm's rails to offer BNPL on their own debit cards.
So Affirm becomes the infrastructure layer for them.
That's the play.
Now, I have to ask about the R word, rent. I saw this in the notes, and my alarm bells went off immediately. Paying rent with debt. That sounds dangerous.
It does. It sounds like a debt spiral waiting to happen, and you are not alone in that reaction. Max Levchin was very quick to clarify what this is not.
Okay.
He was emphatic that this is not paying 12 months of rent over 18 months. He said that would be a subscription debt spiral.
So what is it then?
He calls it time shifting. It's for that specific scenario where your rent is due on the 15th, but your paycheck hits on the 16th.
Ah, okay. So it's just bridging that one-day gap, smoothing out the lumpiness of cash flow, not financing a lifestyle you can't afford.
Correct. And he stressed this is a very, very small test. He said the number of people in the pilot is countable on several people's hands.
That's not a lot of hands.
No, they are treading very, very carefully here.
Good to know. Okay, so to wrap up the strategy, they've also applied for a bank charter, an industrial loan company charter. Why?
In a word, certainty. Regulatory certainty. It's not about getting cheaper funding. Levchin admitted that is years away.
Right.
It's about owning their own destiny. Right now, they rely on third-party bank partners. If they own a subsidiary bank, they don't have to worry about a partner getting cold feet or having their own regulatory issues. It removes the hidden rocks.
It's playing the long game. And speaking of money, the capital markets seem to love them right now.
They really do. They recently priced an asset-backed secured, a bundle of their loans at a spread of under 100 basis points with a yield under 4.6%.
Okay, translate that for us non-Wall Street folks.
It means Wall Street views their loans as very safe. That is the best cost of financing they've seen since 2021. It's a huge vote of confidence. It confirms that the big money trusts their credit outcomes, even if the stock market gets jittery about growth rates.
So let's pull all this together. We've got a company that beat earnings but saw its stock dip because they're playing it safe on credit. They're expanding into everything from stickers to plumbing invoices. They're building AI that shops for you. What is the big picture here?
The big picture is that Affirm is executing a strategy to be a universal network. They don't want to be just a feature on a checkout page. They want to be the Amex of the future. And they are using 0% offers as their moat because they actually mean 0% no tricks. They're betting that in a world of AI and automation, transparency wins.
It's a fascinating bet. And it leads us to our final thought for you to think about today.
Yeah.
As we move toward this agentic commerce where the bots do the shopping, what happens to brand loyalty?
That is the question, isn't it? If an AI always picks the mathematically best financial option, the lowest fees, zero interest, does Affirm automatically win against traditional credit cards that rely on points and perks?
Can a rewards program survive an algorithm that can do the math instantly? If the math says free loan, the bot takes the free loan. It doesn't care about the airport lounge access.
Exactly.
Something to mull over. Check your own sticker empires, everyone. Thanks for listening to The Deep Dive.
See you next time.